Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. Well, September has kicked off on a sweet note, so to say, after the bitter blow, that we saw in August. Seasonality-wise, September is not all that great, but given the fact that there are some tailwinds that we are looking at in terms of the GDP print, and we have the GST reforms with the GST Council meeting this week. So yes, lots to really watch out for, and that has come as a sentiment booster for the bulls. But remember, it's a Labor Day holiday in the US, so FIIs may be absent. That's another leg up that has provided to the market today because we have seen incessant selling coming in from the FIIs, throughout the year. But nevertheless, we'll take it. It's a 200-point surge on the Nifty and a good start to the week and the month as well. The mid-cap index was particularly fired up. Broader markets in fine fettle. The mid-cap index up 2%. In fact, the breadth was also firmly in favor of gainers. There was strong breadth. Advanced decline ratio on the NSE almost 5 is to 2. Sectorally, no points for guessing. Autos, all fired up, electrified, so to say. Sales data came in, and of course, there are hopes of a GST cut as well boding well. And of course, we have the festive season also coming up, so demand uptick is expected. So the Nifty Auto Index up almost 3%. IT also kicked off the week on a good note. Much of the last week we saw selling across the IT pack, barring one day, I think. But IT resumed its momentum. That index was up 1%. Most of the other sectors were also in the green, barring the pharma pack that was under pressure. But all in all, a good day of trade. And if you look at the top movers, 4 out of the first, in fact, 5 out of the first five gainers on the index, all five coming from the auto pack, Bajaj Auto, M&M, Tata Motors, Hero MotoCorp, Eicher, all five gainers on the Nifty 50. The top ones are from the auto pack. Trent doing well, Eternal among the other gainers. Hindalco, ONGC, Asian Paint, Infosys, IndusInd Bank. These are some of the other counters. Thankfully, the losers list was extrememely slim today. So, some pharma names there, the likes of Sun Pharma, Cipla, and you also had Titan that was, out of favor today. Hindustan Unilever as well. After the good week that FMCG had, some bit of profit taking there. HDFC Bank, L&T among laggards, and so was Reliance Industries, extending losses from Friday. So all in all, good day of trade. Autos leading from the front. Even EV two-wheeler names like Ola Electric and Ether Energy, all of them were electrified, and so were some of those EMS names like Keynes and Dixon Tech, and these were some of the other stocks that found a lot of buying interest in today's session. But on that note, to understand the setup, what is it that one should really be doing? Which are the sectors to watch out for? Let's bring on board Nirav Karkera, Head of Research at Fisdom. Nirav, lovely chatting with you, and all the more so given the fact that we've started the week and the month on a very strong note. What is your sense? 25%, in fact, 50% US tariff, the additional 25% came into effect last week. There's a lot of gloom, a lot of pessimism when you look externally. We've underperformed the emerging markets. We've underperformed the US market. There's a stark underperformance, but there are domestic tailwinds. Q1 GDP sprung a very positive surprise. We have the GST reforms to look out for. We had the S&P upgrade. So, there are some headlines that are grabbing attention. Do you think that'll be enough to draw back FIIs into the market? And if not, do you think we are still poised for a fresh leg of rally?
So Nandita, like you rightly said, it has been a wonderful day. In fact, I'm glad the Monday turned out to be this way, and also the start of the month. So, like you rightly said, the tariffs are a bit of an overhang on sentiments. That's the bad thing, right? Everyone knows the bad thing is that the US decided to slap us with some pretty steep tariffs. But at the same time, the good thing is that the worst is behind us. So we know the extent of how far that US is willing to go in terms of imposing tariffs. Now, with that out of the picture, we are left with enough bandwidth to focus on how do we manage it and mitigate it, and what's our sensitivity or vulnerability to the situation, right? So a few good things working in our favor. Of course, there's the S&P upgrade. Another important thing that, it has been spoken about in bits and pieces, but not as much, and I would like to bring a lot of focus back to it, is our sensitivity to these tariffs, right? India is a largely inward-looking economy driven by domestic consumption at large, and that story remains intact, right? the overall Great Indian consumption story is still underway and expected to be accentuated further as we progress into the depths of the festive season. So, near term outlook also looking good on that front. Apart from that, the GDP print also corroborates the same, right? 7.8% has not just surpassed these consensus estimates, but also the RBI estimates, right? So, this is a positive surprise that came in. In fact, this is perhaps the highest in the last 5 quarters that we have seen in terms of GDP print, and a lot of this is coming in from the services industry, right? And some of this is also attributable to a few, and in fact, the sustainability of this is also going to be attributable to a few macro developments. And number one on the board is going to be GST reforms, the collapsing of the GST multi-tier regime into two primary tiers is going to be highly accretive to consumption at large, right? So the collapsing is going to leave people with more disposable income, and at the same time, discretionary spending is expected to come back sooner than later. And as we speak about tariffs and the new world order, we are seeing some sort of a waltz, three-way waltz happening between India, China, and Russia, with all the emerging powers willing to join hands and forces across different sectors and segments, right? So as we speak, the SEO summit is underway, and there are some really high hopes and expectations to come out. In fact, the early signs of such optimism is already coming through the news flows. So India remains resilient, and the allies that it has formed so far with Russia, and the thawing relationship with China is expected to only bolster the outlook further.
Sure. Of course, elephant and dragon are coming together. That's what the two, the President Xi Jinping and PM Modi really discussed, that we are partners more than rivals. So yes, a lot of headlines coming out of there, and of course, visuals showing all three in one frame: Vladimir Putin and Xi Jinping and Narendra Modi, of course. That caught a lot of attention today. But let's talk about the other sector that was in top gear and that really grabbed a lot of eyeballs was the Nifty Auto Pack, right? 3% up move. We'll come to the EV two-wheeler makers shortly, but let's talk about the sales data first. What did you make of it? Because two-wheelers have had a good run. We saw Bajaj Auto beating expectations. Hero Moto hasn't really come out yet. Eicher also, handed in good Enfield sales data. Uh, but what about passenger vehicles? Would you say that it's still some time away, the recovery that we are all anticipating and waiting for?
So with rural demand coming in, three-wheeler, two-wheeler segment is picking quite some pace with the entire macro development working in favor of, economic expansion. Commercial vehicles is also showing a good image, but so far, like you rightly said, passenger vehicles is unable to elicit any sort of optimism so far. But having said that, at the start of the conversation, we briefly spoke about a few developments like the collapsing of the multi-tier GST regime and the closing in of the festive season. And at the same time, we are talking about important relationships being forged between India and China, specifically considering the importance of this equation and what does it mean in terms of input cost for Indian automotive manufacturers, right? And how margin accretive it could be. There are a few stars lining up for passenger vehicles. It may take more than just a quarter, but the outlook from the near to medium term perspective is optimistic on account of these factors playing out.
Mm. One more question then on the GST front. The Auto Inc. is of course batting for a single, rate structure for the entire industry and no bifurcation between, premium vehicles and two-wheelers, etc. How do you think it will play out for, premium players like, M&M for that matter, even Eicher, if at all, the government really doesn't cede to this request or demand, so to say. Do you think these will, perhaps bear the brunt and perhaps take a back seat compared to other players?
So, while of course the industry is right in lobbying and wishing for a single tier structure, but there is very limited evidence to suggest that that the government may be looking at it from the same lens. There is very limited reason to believe that they share the same perspective. There is good reason to believe that there will be a tiered approach and there will be a distinction in terms of how the base level entry level vehicles are taxed and the premium vehicles are taxed. We expect it to be distinct, and having said that, there could be some sort of disappointment, but at the same time, there's not a lot of optimism on this front that has been baked into the prices as yet, is what we believe at this moment. So right now it just hangs in the balance, and our guess is as good as anybody else's, but the probabilities are skewed in favor of differential treatment. So there could be some disappointment, but it is not going to really push back on the entire growth prospects for more premium vehicle manufacturers. It is just not going to be as upbeat as it would have been otherwise if it is collapsed into a single structure.
Hmm. Got it, got it. Let's also talk about the EV two-wheeler makers, right? The likes of Ola Electric. We've seen a phenomenal run, even Ather Energy for that matter. Of course, there's some attribution to perhaps the rare earth curbs, metal curbs that have been lifted by China. But let's also remember the fact that Bajaj Auto, faced, in fact, because of the rare earth curbs, Bajaj Auto EV production got hit. I think because of that, we saw some of the players as well racing ahead. Now, Ola Electric has, I think, regained the second position. Ather Energy, good numbers for August. But going forward for these two particular players, now that the rare earth curves, metal curves have been lifted, Bajaj gets back on track. What happens to these two? How would you look at these two players because they're relatively new in terms of, the competition?
So one thing going well for these two players is that while Bajaj took the utmost hit, their limited scale versus Bajaj sort of insulated them to quite an extent. And from here on, as the curves are being lifted and we gain more access to the rare earth metals, it is going to be more margin accretive and earnings accretive for everyone in the segment. But Bajaj will take a slightly longer runway to resume and regain lost ground, but Ola and Ether will be in the first order of benefiting faster. Here is where a smaller relative scale may be working to its advantage. But having said that, the story is not just limited to access to rare earth metals. There is good reason to believe that there are a few more things happening. So Ether, of course, is growing on its own trajectory, and that is looking good and reassuringly positive. But Ola, on the other hand, is also signaling very good signs of progress. For instance, the very recent PLI certification for its Gen 3 scooters is a very important development, because the certification means that there is more that will be left to trickle down into the bottom line and improve the earnings of the Gen 3 scooters portfolio's earnings going forward. So that is an additional lever that is playing to Ola Electric's advantage. So all in all, the outlook for the segment is good, but Ola has a few things finally going right for it. And of course, it all hangs in the balance of execution capability. But over there also, there's very limited reason to expect faltering, considering how the assembly lines and the business so far has been building for this moment on and ahead. So the outlook remains upbeat on this account.
So are you comfortable with the valuations, especially given the rapid rise these two stocks have seen over the last month or so?
So the valuations may seem slightly on the stretch side, and that is also because a lot of positives have been factored in aggressively, priced in aggressively. So it's not just the PLI certification in the case of Ola, but also the rare earth metal curves being lifted on. But also there is a festive demand expectation, anticipation that is being baked in aggressively into the valuation right now. So yes, valuations may seem to be on the steeper end, but this also entails that there is very little margin of safety from here on, and disappointments on the execution front or in terms of the sales numbers coming in the next subsequent 1 or 2 quarters may lead to a steeper fall than earlier anticipated. So yeah, valuation slightly stretched and reasonably low margin of safety at this point and this juncture.
Hmm. Got your point. Another auto ancillary, so to say, Samvardhana Motherson, that was in focus today, has made an acquisition of a Japanese company, and Speed believes that the valuations at which this acquisition was made is fairly attractive. Just going through Nomura's note, they said that the acquisition is valued at 4 times FY27 PE, which is extremely uh, uh, you know, uh, attractively valued. So, in terms of the business going forward, would you expect this to be EPS accretive pretty soon from year one itself? I mean, how are you viewing this acquisition, particularly for Samvardhana Motherson?
So for this acquisition, it's an important acquisition in Samvardhana's scheme of things, right? And we would not look at the PE in isolation. So FY27 4x multiple on PE may or may not make sense in isolation, but here's what makes it look like a very good deal, right? There's an 81% acquisition of Yutaka Gaiken, right? And 11% of Shinchi Kogya. At the same time, the company has very strong intention to take up 100% of Yutaka owned Auto Parts India, which is a private limited entity, right? Either directly or through
Mm-hmm.
subsidiaries. So the overall scheme of things ensures that Samvardhana gains access to capacities and capabilities into the metal component and assembly manufacturing lines that Yutaka already owns and is running pretty efficiently. This includes several parts like motors, the drive systems, brake systems, thermal management systems, right? So this is a very good IP and capacity that Samvardhana starts getting access to. At the same time, on the cap table, there's also Honda on the other side of Yutaka, right? Roughly around 18 to 19% is our estimate that Honda would be owning. So this acquisition also has a second order effect of a very strong case where synergies improve to strengthen Samvardhana's partnership with Honda, and it will be able to increase its partnership share of business with Japanese OEMs. So this is a second order effect that that is highly synergistic and expected to be earnings accretive. A third order effect is once Samvardhana gets access to the OEM portfolio that Yutaka brings to the
Mm.
deal, it will be able to take this portfolio to several other OEMs, especially in the emerging markets, and be able to garner some more top line from this portfolio being taken and showcased around to other OEM businesses. So all in all, the synergy prospects of this acquisition is something that makes the deal really lucrative and puts the 4 times multiple much more into perspective, and which leads to the conclusion that this could be EPS accretive much sooner than anticipated. Of course, it would be difficult to put in a timeline, but could if things fall into place the way we expect it to, it could be seen really early in the near term itself.
Got your point. Okay, that was about Samvardhana. But just one more question about related to GST. FMCG, that index saw a good comeback in last week. This was the only pocket that managed to stand out, in a very gloomy scenario. But I just want to ask you, in terms of the GST reforms and the change in the rate structure, how would you play consumption? Would you look at consumer discretionary, or would you look at staples? And within staples as well, we saw stocks like Colgate stage a very good rally last week, I think on Friday or something. GST cut doesn't mean, I mean, one would argue it doesn't mean that you're going to start brushing more and consuming more toothpaste, right? So, I mean, what is it that's moving the needle for these particular stocks? And, should one really play this GST rate cut theme via staples? Because staples haven't really moved the needle so far when it comes to returns. Your thoughts on all this debate?
So, Nandita, like you rightly said, broad-based consumption was already underway, and a lot of this broader consumption has been baked into the valuations of most consumer staples companies that are listed out there, right? So far, we do not expect the GST cut to have any meaningful impact beyond a point on consumer staples. Also, considering that there's very little buffer zone in terms of valuation comfort available there, considering everything that is expected to come from a consumption uptick has already been expected, right? However, the story is slightly distinct for consumer discretionary, wherein we expect a fillip in consumption discretionary spending across not just the festive season, but amid lower outgo on account of a collapsed GST structure, would augur much better and would much uh, in a much better way for consumer discretionary stocks before it starts really moving the needle for consumer staples. So if we were to make a choice at this point in time, while being very conscious about the valuation and the growth levers that are coming in and GST's direct benefit and the extent of it, we would place our views more optimistically on consumer discretionary versus staples at large.
Hmm. Right, got your point. I want to also talk about IT because today, of course, the sector saw good gains. In fact, last week as well, I think one of the days, I think it was Monday only, when we saw IT stage a very good rally, but then it kind of fizzled out and turned out to be a one-day wonder. But a lot of experts I've spoken to are of the view that the worst may already be priced in for IT, and now that after looking all the data and the in fact hopes are high that we could see a resumption in the Fed rate cut cycle as well come this month itself. One of the notes from CLSA said that perhaps 75 basis points, in upwards of 75 basis points, kind of a rate cut could be expected from the Fed going forward. Uh, how would you put all this into perspective when it comes to IT? Because at least valuations wise, things are looking pretty good, if not earnings wise, in the immediate future.
So the stage is set for an accelerated rate cut regime by the US Fed, right? The numbers are pointing towards it. The markets are discounting it. One thing that we are really uncertain of is the quantum and frequency of these rate cuts. Whether that's going to be aggressive or not. So while the outlook may be of anywhere between 75 to 100 bips, what really matters is in how quick a succession is that going to come in, and what is the first set of rate cuts going to look like? Are they going to front load it or not? Expectations are that at this point they are going to even it out across and wait till more data points emerge. So our expectation is that the first round should be of around 25 bips in the upcoming Fed meet. But having said that, that is just one lever working for Indian IT. Most other things working in favor is, of course, services contribution to overall GDP has been picking good pace. Domestic macros are looking good. So many domestic inward-facing IT services companies are having a certain meaningful percentage of their portfolio catering to domestic demand, acts as a very good insulation. Point number two, the demand pipeline continues to remain robust. Of course, there is some fatigue and some indecisiveness on the client side. It is not as if they're exactly queuing up, but this and a lot more than this has already been penciled in by the street into the prices and the valuations. So the valuations
Hmm.
at this point in time, especially considering that the worst could be behind us, seems to be an attractive entry point from a medium to longer term horizon. In fact, the valuations seem to be much more lucrative on a relative basis for large cap IT and tier one mid cap IT more than the others. So from here on, it could start witnessing a lot of value oriented buying is our expectation.
Hmm. Another thing that I want to point out is the fact that the rupee is at record low, right? On the one hand, exporters, of course, are under pressure because of higher US tariffs. So, would you expect the rupee or the RBI to leave rupee at these levels? Because at least that would provide some tailwind to exporters, right?
So it would definitely prove to be a tailwind to exporters. And having said that, RBI so far, across several instances where the rupee depreciated by a meaningful extent, has been very deliberate about its approach to intervening in the forex market. It clearly does not seem like RBI would like to maintain a certain range through active forex management. So the free forces will sort of determine the direction of rupee going forward, unless it is a very a very drastic slide. We would not expect RBI to very actively bring rupees back to higher levels. There would be natural courses of event that would be allowed to take its place and course as we progress. So RBI generally, if the action so far across various events were anything to go by, it would adopt a hands-off approach unless absolutely critical.
Hmm. Got your point. Nirav, last question really. So far this has been a market where there's been a lack of leadership. So to say. On a daily basis, you do see some sector coming up. Like today it was autos. One day it was IT, but there is no clear leadership as of now. Where do you expect that leadership to come from? Because banks clearly are not taking the lead. In fact, they've been underperforming. If you look at the last few weeks, I think even months for that matter. So, my simple question is, where is it that the leadership will come from for the next leg of the up move in the market?
So our expectation is that leadership is going to be fragmented with everything that's happening on the global as well as domestic macro front, and sectors specifically the ones that are heavy weighted and represented on broader indices continue to remain under pressure. So this becomes a very classic bottom up market wherein company specific developments will witness buying action. So leadership is expected to be fragmented from the near to medium term perspective. It would be very difficult to bring them under a single umbrella, at least in the near term. So it may be very difficult to label a particular segment or sector to take charge of the next leg of rally. It is more likely to be fragmented and be driven by the forces of multiple candidates, and not just a single sector in the near term at least.
Got it. Any sectors that you guys at Fisdom Research particularly find very attractive?
So right now, we like these spaces. We like the NBFC space within financial services. It is looking good, right? With the balance sheets getting healthier, with the demand side growing more robust, with underwriting practices improving, NBFCs are looking great at this point in time. There are several PSU banks that have been able to clean up their balance sheets and have been able to sustain good quality of books. And it is no longer the case wherein they are lagging significantly versus private counterparts. They are able to improve their operating efficiency and models on the ground. So that's looking good for us. On the commodities side, we have been optimistic on gold and silver as commodities since almost over 6 months now. So that remains an important piece for us. Apart from that, we believe that there would be very limited segmental areas of interest. Rest of it is going to be in niche subsegments that has more to do with discretionary spending on the retail consumption side, and very selectively on the auto and telecom side. Power is another segment that we're liking, but again, very selectively on the power side.
Got your point. Those are the sectors, the NBFC, power, etc. And with that, Nirav, I would like to thank you for taking out time and joining in this morning, this afternoon, I beg your pardon. But yes, it was a good day of trade, and I hope we have more such days. But of course, we have that all-important GST Council meet later this week. I hope to connect with you again and have a discussion then as well. Thanks a lot for taking out time and joining us.
Likewise. Thank you, Nandita. Pleasure speaking.
Thank you. Thank you. Well, on that note, we've come to the end of this edition of Closing Bell. It was a good day of trade, 200-point rally on the Nifty, 24,600 back on the charts. Mid and small caps were all fired up, with the mid cap index gaining 2%. So yes, a good day of trade and a sweet start to September after the bitter blow by August, so to say. But let's hope this momentum continues. With that, thank you for tuning in and staying with us throughout the course of the show. I'll see you again tomorrow morning at 9 a.m. With the market action, with a new set of guests, and with all your queries as well. So keep them coming in. But have a great evening and stay tuned to Money Control for all your other news and updates. Thank you.